So my near term, I'm long Bitcoin. So I do like Bitcoin just for a little bit of a move up. I've been in since it basically got down to the 20,000 marker, which was major support from the 2017 highs. But I'm basically looking to exit around 25.5 to 28. And then I think we do have another leg down midterm. So yes, long term, I think it is the future. I think it's going to be the alternate to gold. And again, I don't think it replaces gold. I think gold is always going to be there. But in terms of trading in and out, you're buying physical metal, you can't really just go to the store and just sell it real quickly. And I do think that, again, the ease of transferring Bitcoin around the world makes it a very viable commodity. I'm not sure about the altcoins, how those will fare, but I do think, again, long term, yes. I mean, so near term or midterm, down to 12 to 13,000 on Bitcoin, and then long term, I do think 100, 200, 300,000 is very possible. Markets went back so quickly to their all-time highs. And so they're all saying, well, here we are basically the same thing. We're probably going to be back at all-time highs in a few months. When that doesn't happen and we break the lows on the stock market in the next, let's say, 3 to 6 months, now you're going to have a kind of a reckoning where people are going to get very, very scared. Scared money is going to be selling money, and it's going to drive the markets down very, very sharply. The markets, to understand whether it's commodities, crypto, or stocks, or really anything, even real estate, it all comes down to psychology of the human race, right? So when you're trading anything, you're trading other humans that are trading back and forth, right? So they're deciding it's a good buy, they're greedy, they're fearful. And so that's really what you have to start to understand to become a level playing field kind of trader, where you're not influenced by those metrics. And we see it so much today, especially with social media, where people start to pump stuff on social media and you see everyone just get so excited and they buy in at the highs. And the key is to kind of understand not to do that and how to step back from that. So that's part of it, absolutely. And then you go into things like personal. Obviously, 20 years from now, I think the markets are probably much, much higher. But I would say the next 1 to 2 years are going to be very tricky for the stock market. Very, very tricky. Even when the Fed comes out and prints money, I think it's going to be a tricky scenario because, again, it creates, yes, more money in the system, but it's also going to create hardships for investors trying to figure out, well, where does this end? And essentially, where does all this money printing end? And does the dollar then start to collapse? I even am a very long-term bear, and I'm very scared, investor for the future, 5 years out, 10 years out for the US dollar as well. And it does make me wonder if the future is more of a Bitcoin type, kind of a economy, or a crypto economy where there are restrictions on how much can be printed, how much debt the US can actually issue. And I do think as Americans and maybe as global citizens, people are going to say, hey, listen, we need to really keep our governments in check, because what they're going to do is just eat away the buying power of every single person by stimulating, and it doesn't work. It's not feasible long term. So there probably is more money in the markets, but the key is always remembering that investor psychology doesn't change. So as much money as that goes in creates these bigger bubbles, like you could arguably say we're still in. And I think even on this pullback, right? So the S&P was down about 20%, but all the investors that came in the market since COVID, which is 2020 of March, they all saw how much we were down. We were down, 30% in a very short amount of time, and how the discipline, right? That's a key component of any investor or trader. And that comes down to the same kind of concepts about not chasing a trade. Can you be disciplined and make sure when you do your analysis and say, I believe this commodity is a good buy at this price, can you be disciplined enough to be patient and sit there sometimes for weeks or months until it gets to that level where you actually execute that trade? And most people don't have that ability. They don't have that discipline. And then we obviously get into the technicals, right? And technicals, I would say at least about 75% of what I do is pure technical. And that gets into chart setups, patterns, pricing, timing, cycle work, all that kind of stuff. So there's a big kind of mishmash that goes into what I do, but I do try to stay away from the masses. When I hear everyone else getting excited about something, believe it or not, my brain is so trained that I start to think, okay, well, how do I go inverse to this? Because there's probably a top coming, let's say. And you can see it, by the way, you saw it in crypto, you saw it in the Russia invasion of Ukraine, how oil popped, all the metals popped, everyone was like, oh, these are going to the moon, and we see what happens. They all come back in. Yes, yeah, if you're looking to just basically be safe, then something like a gold is where you want to be right now, because you don't have that inflation eating away at profits like it does for the miners there. Absolutely. In fact, I often kind of liken what's going on with inflation and the costs of mining, and this is kind of a weird take, but I think it makes a lot of sense. I don't know how many people out there listening know about crypto and how oftentimes you'll see these periods where Bitcoin, it becomes harder and more expensive to mine Bitcoin and crypto. And so the miners for crypto, if the price is not higher, then they stop mining, right? It doesn't make sense from an energy perspective for them mining to make profits on Bitcoin at a current price. Well, guess what? In a weird way, that almost is going to work the same way for the miners and for gold, because in fact, I think Newmont Mining said something like this. They were going to stop mining one particular style of gold because the cost was now too high. And what that's going to ultimately do, it's going to force the price of gold to go up because you're going to see less mining going on. And so it works in very similar ways where it'll actually push the price. So the higher inflation goes, in theory, it should actually push up gold just because of that, because more miners will stop mining the more expensive techniques. We were seeing interest rates, right? We saw interest rates starting to come down, which generally has been correlated with a pullback in gold prices. No, that's not necessarily true. Oftentimes you'll see it go in the opposite direction. But the biggest thing to me was that the Federal Reserve was kind of making it out like, hey, listen, guys, we're going to create a soft landing. We're going to be able to land this plane carefully where we're not going to push us into recession where we need to print money again. And I think that was the key here. But I do think that is going to fall apart. I think this bounce back in gold has been awesome from 1680 now to 17, like you said, 1800 or so. And I'm still very, very bullish, because the long-term thesis has to be that while the Fed can't print money now with inflation at 10% or so, you get inflation to 4%, like I said earlier, and you get unemployment to start to spike in a bad recession, and the Fed is going to have no choice than to start to stimulate again. And it's the destructive nature of this kind of save the day mentality, which I understand. You know, it has saving the economy has this altruistic. I mean, it's the idea is good, but it's not healthy for the economy longer term. And I think that's the kicker, is that ultimately you're killing the economy longer term. You're creating bigger bubbles that then have bigger collapses. And eventually the Fed isn't going to be able to save the day. So longer term dollar weakness means gold should break out to the upside. Generally right now, I'm more in the gold miners, the Newmont Minings, the AEMs in the world here. And basically, again, the same kind of thought process is that I do worry about the economy. And if we get, you know, some bad economic numbers on any one day and you start to see a lot of these industrial commodities start to slide again, it just makes me nervous about kind of putting too much money in those right now. Versus gold, I look at it like, all right, you know, gold, even if it goes down near term, it has that upside that I view on the future money printing. And so it's a little bit of a safer trade. I think so. I've talked a little bit about it here and there, but I haven't talked about it recently. But I do think that at some point in probably 2023, the economy is going to be in such dire straits that the Fed will have to come out and basically say, hey, we're going to lower interest rates. We're going to stimulate the economy. The government will see pressure to do more stimulus as well. And I really do think that is going to be the turning point for gold, when the market and investors start to realize that there's never an out from printing money. That this basically tells you that 20 years from now, you're still going to see every recession a printing of money. It's going to mean that gold is going to have a big move up. Yeah, I think that's the key is the time frame wise. So I mean,